Welcome to Bloomberg ETF IQ Europe. I'm Yousef Gamal El-Din. Over the next 30 minutes, we'll be your guide to the region's thriving market and exchange-traded funds. Everything you need to know about the funds and the flows. European ETFs tracking the Nasdaq have attracted more money this year than funds following the S&P 500. We'll discuss the triumph of technology. Well, there's a gold rush in the ETF business. Exchange-traded funds now hold more bullion than every central bank except the Fed. But who exactly is making the money? And marijuana, robotics, and AI, Europe's retail investors pour money into thematic ETFs. We'll ask if they're a good way to target a trend. Well, let's kick off with the rise of the stay-at-home economy trade. European investors have been piling into an exchange-traded fund that tracks the tech-heavy Nasdaq. It's a household name. It's your Invesco Triple Q Trust Series 1, which counts Apple and Amazon as its top holdings. That's received nearly $2.4 billion of inflows this month. In fact, this year, Europe-listed ETFs tracking the Nasdaq have attracted more money than funds tracking the S&P 500, and that is the first time it's ever happened. Joining us now on the phone is Athanasios Sourafagis from Bloomberg Intelligence. So how large are the Nasdaq ETF assets when compared to some of the S&P 500 ones?
Hi, Yousef. Good morning. So, the Nasdaq, given how strong its performance has been, it's predominantly underrepresented in assets, both in Europe and in the U.S. So to give you some context, there's about $100 billion in S&P 500 products in Europe, and there's only about $16 billion in Nasdaq products. And when you sort of look at some of the reasons why, traditionally a lot of people and investors, active managers, are just benchmarked towards the S&P 500. They don't really use the Nasdaq 100 as a benchmark. But this year, given how big the performance differential has been. So, for example, the Nasdaq 100 is beating the S&P by 25% this year. People have been forced to notice the strong performance of it, and you're seeing it in the flows. And this is really odd for the most part because there's just less Nasdaq 100 products. The universe just tends to be dominated by the S&P 500. So to be able to see the Nasdaq flows outpace the S&P is actually quite an accomplishment, given that there's so fewer products. But the way the Nasdaq is constructed, it's just been a benchmark that's been more conducive to this current environment. It's tech heavy, it's healthcare heavy. There's no financials. It's just been a benchmark that's just been able to outperform the S&P, and people are taking notice of that.
And how is this all translated into equity flows overall compared to other areas?
Yeah, so what's interesting, and given the performance of the market since the bottom, so for example, the stock 600 is up 35% since the March bottom. Flows to equity products have been really underwhelming compared to the other asset classes. Everyone really poured into fixed income, and a lot of that was led by support by the central banks globally into bonds, and that's really translated to flows for that. But what I think is if the Nasdaq continues its performance and we see other areas like thematics continue to do well, the relative lagging of the equity flows are going to catch up later in the year. Just the fourth quarter tends to be heavy for equity flows, and I think that given how underwhelming they've been, you might see people performance chasing. They might start to pile in more into the Nasdaq or more into these thematic products, and I think that you're going to see equity flows jump up. And to give you context of all total equity flows in Europe this year, the Nasdaq products have accounted for 30% of all those flows. So there seems to be this motion towards chasing performance. And I think if that performance continues, you'll see equity flows turn up later in the year.
Athanasios Sourafagis from Bloomberg Intelligence, thank you for those insights. Let's get some additional perspective. Joining us now to discuss all of it all, it's Matteo Andretto. He is the EMEA head of SPDR ETF business at the State Street Global Advisors team. I want to get really into the thick of it because the question becomes, are we going to see more reallocation into some of these technology trackers if individual tech stocks outperform?
Hi, good morning, everyone. Yes, for sure. I think that's exactly what we expect. We expect investors to keep using sector ETFs over the next few months, especially ahead of the U.S. election for their reallocation post-summer. And we clearly expect a continuous trend into technology and potentially also into healthcare. If I might just point out also one additional observation regarding the Nasdaq 100, clearly there is a strong outperformance that is driven by the tech component of that index. But also investors have to realize that by buying Nasdaq 100, also they expose themselves to other sectors that maybe they don't necessarily want to have exposure to. There is a particular portion of healthcare or a portion of industrial and engineering where I'm not sure that they will necessarily benefit from the current trend and the current positive fundamental underlines that we are seeing necessarily in technology.
I'm beginning to wonder whether a lot of the other newer, smaller, more creative tech ETFs are going to be able to replicate the kind of success we've seen in the triple Q. I'm thinking along the lines perhaps of some that are sort of trying to build on, say, what's happening in the cloud space. Or is that something that, for a wide variety of reasons, is very unique to the structure of the triple Q?
Well, there are some very interesting aspects of when you start looking at the sector ETFs, the triple Qs, so the Nasdaq 100, and clearly all these thematic products. And really, we have to go into the details of how the index per se is constructed and the underlying basket is defined. The problem with some of those thematic ETFs are clearly that the basket, so the underlying securities, are predefined when the basket is created. And therefore, there is very little possibility of capturing new emerging technology, new emerging companies that will eventually enter the basket. Really depends by the index methodology and what type of reshuffling, what type of rebalancing the index really is subject to. When we are really looking into a cap-weighted index, if it is technology in particular, because that's what we are really want to have exposure in the current trend, because clearly technology is what is changing the way we behave, the way we work, especially in the post-COVID crisis, we might want to take a direct exposure to an ETF that is investing in that sector so that you can also capture all those new emerging companies that will eventually be part of the index straight away without necessarily having the constraints of the top 100 companies that are listed on Nasdaq. Also because the listing value, it is very important, and clearly Nasdaq has a strong history of capturing some of those companies, but potentially they may eventually be listed somewhere else.
As much as the triple Q was able to lock in a sizable amount of inflows, you put that in perspective and you look at how that compares to exchange-traded products in the fixed income space. And the message that really comes from that is investors are still quite risk-averse. How do you explain that?
Well, there is clearly, I think, a very strong difference of what we have seen so far in the type of themes that are played through the equities and through fixed income. In fixed income at the moment, the two major themes are, one, the continuous chasing for yields, and therefore we have seen significant flows into investment grade and the corporate market, in particular, both in Europe and in the US, but also the underlying trend, the underlying theme that is clearly investors are still developing is don't fight the Fed. So we know that the Fed is active in the ETF market. We know that the Fed is active in directly buying securities through their program. And clearly that is, that there is a very strong underlying theme that investors still want to exploit without taking additional risk to their portfolios. In equities, I think is a different situation. The Fed is not buying equity, and it's not supporting the economy in the way, the way Bank of Japan has been doing for many years in Japan by buying direct stake into listed companies. And therefore, what investors are really focusing on is what has changed since the COVID crisis. And what are the implications of that? And clearly, the two winning themes of that is technology and healthcare, and the relevance of those two sectors to the overall economy.
We'll pick that up shortly in more detail. Matteo Andredo from State Street Global Advisors stays with us. Here's a bit of a snapshot then of what is in the pipeline. Retail investors in Europe have been pouring money into thematic ETFs. We're going to ask if they're actually a good way to target a trend. That's next. This is Bloomberg. This is Bloomberg ETF IQ Europe. Everything you need to know about the funds and the flows. I'm Yousef Gamal El-Din. Thematic ETFs are touted as an easy way to target a trend, investing in things as diverse as video gaming, cannabis, and artificial intelligence. It seems European investors are finally getting on board. So far this year, more than 9 billion euros of the equity products have been bought and sold. That's more than double the volume in the same period last year. Joining us now is Bloomberg's Simone Foxman. Simone, which ETFs then in the space have drawn the most interest?
Well, Yousef, two ETFs, and these have to do with video gaming and computing. One, the VanEck Vectors Video Gaming and Esports ETF. That's up 62% year to date and focuses on that gaming graphics cards kind of component. Another, First Trust Cloud Computing. That's a little bit broader, more consumer names. That's up over 30% this year. And both of these capitalizing on this really meta trend of folks, particularly retail investors, sitting at home on their couch in their pajamas, trading in the markets, betting on folks at home sitting on their couch playing computer games.
And then you've got some excitement from retail investors translating to the broader European ETF market as well.
Yeah, well, so those thematic ETFs, the thinking is that this is really a retail play, but it's unclear that this is actually filtering through into the broader European ETF market, where retail investors just haven't been a big part of. Though the one place I would say you should look at if you are looking for a sign that the retail investor is gaining momentum is Vanguard ETFs, because they are a common tool of retail investors. And if you look at the Vanguard FTSE Europe ETF, you'll see that we've seen quite a strong series of inflows recently. In fact, the best day of inflows since 2017 happened just earlier this month. So some positive signs, I suppose, if you're looking for the retail investor to play a bigger role in this market.
Simone, thank you very much for those details. That's Bloomberg's Simone Foxman. Let's get back then to our discussion with Matteo Andredo from State Street Global Advisors. He's still with us. Matteo, I mean, as much as there's a lot of creativity in these new ETFs, especially that are trying to target European investors, the concern is that they're not going to generate enough liquidity, and for many investors, it could become a bit of a trap.
I think you're raising a very good point regarding liquidity of the instrument and the underlying basket. As we said, the devil is really in the details regarding some of these products and some of the mechanics for the inclusion of the new securities. So while on one side there is the possibility that if the rules allowed, new securities, so new emerging companies could potentially become part of the basket underlying the ETF. At the same time, liquidity will really be a challenge. And that's the reason why we will be extremely cautious in terms of using them as a trading tools. We definitely see a space for thematics as part of the overall portfolio construction, and there are some of them where clearly you are exposed to the long-term benefit of some of those themes. But clearly, if you are really after a diversified basket of companies where new companies will always become part of it, and you don't necessarily have any constraints regarding the listing value, buying directly a technology ETF might be a significant better bet. On the same time, just an observation regarding some of those themes, we have seen a lot of interest as well of really developing of the identification of which themes are here to stay. Cloud computing, we talk about video gaming, but what about the ESG and the environmental, social, and governance? Those are clearly, that's clearly a big theme also in European ETFs, where we believe it's going to be a significant driver of the growth of the market, and it's clearly something that is here to stay.
Yeah. Matteo, can regulators do anything to help catalyze additional liquidity around European ETFs? Is there something they can do?
Well, it's a very good question. And if we look at our experience in the US as State Street Global Advisor and in the SPDR business, the ETF business, clearly, having been the one that launched the SPY, more than 20 years ago, we are clearly very close to the liquidity and what is necessary to become a significant liquidity player in one of our instruments. And clearly what is necessary is the creation of the overall ecosystem around the product. So the product has to be used and accepted for collateral and stock lending. A significant option part of that liquidity will also come from the option market. In Europe, some of those infrastructures and building blocks around the ETF UCITS market has not been necessarily developed yet. But it's also true that in Europe we are not as mature as the US market. So it's just a matter of time. And for sure, we will see a growth driven also by those technical aspects of the ecosystem around ETFs.
Matteo, hold that thought, Matteo. We're going to get into some of your other calls shortly. Matteo Andreato from State Street Global Advisor stays with us. In fact, here's what's coming up. ETFs now hold more gold than People's Bank of China and the Bank of Japan as well. But who's making all the money? Discuss that next. This is Bloomberg. This is Bloomberg ETF IQ Europe. Everything you need to know about the funds and the flows. I'm Yousef Gamal El-Din. Well, in California, the gold rush is the surest way that a fortune was set to be made in the pick and shovel business. Well, if it's 2020's gold fever hasn't an equivalent, then it is the ETF business, of course. They now hold more bullion than every central bank, with the exception of the Federal Reserve, and that is generating a lot of fees. Let's get more with our Bloomberg reporter, Justina Lee. Justina, who are the ones then benefiting from the boom in gold ETFs?
Well, most directly, you can imagine the boom is benefiting the ETF providers, which charge fees as a percentage of the value of their assets. For example, Bloomberg has calculated that the total fees for the top 10 gold ETFs based on current prices are around $610 million a year. And for the top 5 silver ETFs is around $110 million. And kind of less directly, it's also benefiting, the few big banks like JP Morgan and HSBC that hold the bullion on behalf of the ETFs in underground vaults.
I look at some of the other commodity ETFs, and I'm thinking around oil in particular, and what we saw with the U.S. oil fund earlier in the year, how quickly something that might seem mainstream and popular can run into trouble. What kind of hiccups have we seen when it comes to the surge in demand for gold products?
Yeah, it's been pretty interesting. For instance, if we look at GLD, the most popular gold ETF out there, their report has revealed that starting from April, it actually owned some gold that was not at HSBC, but rather at the Bank of England. And that was because, the pandemic made it harder for the BOE to move the metal quickly enough to HSBC's London vault. And, at the same time, there's also been a little bit of a problem with silver, which is bulkier and less valuable than gold and also takes up a large amount of space in the vault. I mean, at the end of the day, the bankers and the logistics providers do say there is enough space, but it just kind of reminds you of, the particular problems that comes from having physical assets attached to these securities.
Justina, thank you very much for those views. That's Bloomberg's Justina Lee. Let's get back into our discussion with some final thoughts from Matteo Andreato from State Street Global Advisors. Matteo, the real difficulty with some of these gold ETFs is that we might just be getting started in terms of their popularity. PIMCO sees current gold prices at actually quite cheap compared to their historical averages. So if we still have quite a bit of upside in the pipeline, can these ETFs handle another surge in demand?
I think that you are right. So what we are seeing is clearly a significant reallocation to gold as part of the overall strategic allocation and as a core component of the investment portfolios. Now, there are fundamental reasons why that is the case, driven clearly by the weakness of the dollar, very low rates, and the fact that the investors, retail, wealth, high net worth, and institutional were structurally underweight to the commodity and really dragged the prices down for a prolonged period of time. What is going to be very interesting to see is how does that reflect the current dollar weakness, and how is that theme going to be played only through gold, which clearly, being a real asset, should outperform in a weak dollar scenario, or eventually will migrate into other asset classes or other type of exposures. In a dollar weakness, clearly, what should also outperform are small cap, emerging markets, that all things that are not necessarily popular at the moment, but we might actually see a significant shift of the investor attention away from gold because of the dollar weakness into some other assets that are sensitive or negatively correlated to a weak dollar, and that clearly might eventually come over the next few months. So you are absolutely right. We might see a continuous momentum was driven, and I think the significant flow that we have seen was driven by a structural underweight to that commodity in the asset allocation. But now the theme is really weak dollar, and now we're going to play for that.
Matteo, briefly, do you think those fees are going to come down for the commodity ETFs, given the competition?
Well, in general, what we have seen is clearly a contraction in fee, and the repricing in the ETF market. It is something that it's here to stay. We have always to be very careful and not just look at the total expense, the expense ratio, so the fees that are charged as part to manage the ETF, but also the total cost of ownership. Yeah. So what are the spreads that investors are currently paying in the market to trade with those products?
Matteo, thank you very much. Really enjoyed our conversation. That's Matteo Andreino from State Street Global Advisors. Well, that's all we have for this week's Bloomberg ETF IQ Europe. We'll be back with more from the world of exchange-traded funds next Wednesday. This is Bloomberg.